95% of colleges that use a federal methodology to determine your EFC, your expected family contribution, the IRA as an asset is typically not calculated against you, has no impact on you being able to receive financial aid. So according to Sallie Mae, more than 10% of families are currently utilizing the retirement assets to help pay for college. And more than 25% of families are willing to use the retirement savings to help pay for school. And that's crazy. So when it comes to IRA, once again, IRA stands for Individual Retirement Account. So there's multiple IRAs. More commonly, there's a traditional IRA and there's a Roth IRA. But there are more IRAs. You have a traditional, you have a SEP, a simple, a non-deductible, spousal, and a Roth IRA, or not to mention a self-directed IRA. IRA is basically a tax-sheltered vehicle. You put money in, assets in, or contributions from your paycheck into an IRA. IRA is kind of like an umbrella. Everything that goes under that umbrella is sheltered from taxes. So as you contribute and you set money aside, it grows tax deferred. And then depending on the type of IRA, once you retire, you pay taxes on those funds. And a Roth, it grows and you can pull the money out tax-free because you made a post-tax contribution. Whereas in a traditional and most other IRAs, you put pre-tax dollars into this particular bucket, and then when it grows tax deferred, you decide to pull those funds out. So unlike a 401k, when it comes to college, a 401k, you can borrow from your 401k to help pay for school. An IRA, you typically are taking a withdrawal. But one of the benefits of using IRA, when you pull that money out to pay for college, if it's a qualified educational expense, there is no premature distribution tax penalty of 10%. So qualified education expenses can be tuition, fees, room and board, supplies, any kind of educational equipment. Using that money can only be for yourself, your spouse, your children, and also your grandchildren when using the IRA. So some of the advantages and disadvantages to using an IRA. When comparing an IRA to a traditional savings account, it can be more beneficial because the potential for growth and your higher rate of return within the IRA is a lot greater than what you would get in a savings account. The money in the IRA, as I mentioned a little earlier, it does grow tax deferred. If you recently retired or you separated from a previous employer and you had a 401k or a 403b, 457, you can roll those assets into an individual retirement account. About 95% of colleges that use a federal methodology to determine your EFC, your expected family contribution, the IRA as an asset is typically not calculated against you, which means that it doesn't raise your EFC and reduce your aid eligibility. It does not. It has no impact on you being able to receive financial aid. If you're considering using your IRA to pay for qualified educational expenses, the distribution or the withdrawal from your IRA must occur in the year that the expense occurs, the same year. So you can't pull money out of your IRA a year before because you know you have these expenses coming up next year. At the same time, you can't incur these expenses this year and decide to pull money out of your IRA the following year. The distribution and the expense have to occur within the same year. If you're using a Roth IRA and you're considering using a Roth for paying for college, you must have the Roth IRA established at least 5 years before your first withdrawal. So although in a traditional IRA, the asset is not counted against you and it doesn't have a negative impact on your EFC or aid eligibility, the contributions to your traditional IRA, they do, and they are considered untaxed income. So what that means is that the asset may not have a negative impact on your ability to receive financial aid, but the untaxed income is added back to your overall income, and that can reduce your aid eligibility or raise your expected family contribution. You cannot double dip. Sorry families, unfortunately, you can't double dip when it comes to some of the tax benefits of using your IRA to pay for college. So if you are using your IRA for qualified educational expenses, means that you can pull the money out of your IRA and not have to pay a 10% premature distribution tax. Yay for you. But at the same time, if you're getting that penalty waived, then you cannot qualify for any educational tax credits. Using your traditional IRA to help pay for college, The income or the distribution that you take from your IRA may come out penalty free. There's no 10% penalty if it's for qualified education expenses. However, it's not tax free. So if you're pulling money out to pay for college, it is considered income and will be taxed as such. Also reduces your aid eligibility and raises your expected family contribution because you just got an income. So here's a couple tips or things to consider. The advantages of using a Roth IRA over a traditional IRA, especially when paying for college, is that you can pull the funds out penalty free, but you also have the ability to pull those funds out of a Roth and pay no income taxes on those funds that you pulled out. So for example, if you've had a Roth IRA, you contributed to a Roth over 7 years, and let's say you put in your own money, about $40,000 into your Roth. Those funds have grown to be $65,000 today. First $40,000, which is your cost basis or your principal, you can use to pay for college penalty free, as well as tax or income tax. Many families pull up to that $40,000 threshold and they leave the rest inside the account to keep their retirement earnings intact so they can continue to earn and grow and then be used for retirement needs in the future. One of the drawbacks to using a Roth, the distribution in future years can be considered as untaxed income, and that can boost or raise your expected family contribution. One way to avoid this situation we recommend is that you delay or defer using your Roth IRA for college, as we want you to use it in the later or final years of college, typically your student's junior year or senior year in college. By doing so, if you use it in the junior or senior year in college, we're on the prior year look back when it comes to your EFC and financial aid. So if you use it in your junior year or your senior year of college, by the time that income as an untaxed income hits your profile, you're already graduated college and there's no need to have a reduced EFC because you don't have to pay for school anymore. Unless you have other kids that will be coming into college. If you're just looking at this one student and you're considering using these funds for that one student, then you have a benefit of using it in the later years. I know that was a mouthful. If you have questions about it, please comment or reach out to us. In the end, the bottom line, the best tip that I can give you, if you're considering using your retirement accounts for college, it should be a last resort. It should be limited and it should be avoided as much as possible. If you have to do it, you got to do what you got to do. But we recommend trying your hardest to reduce all your expenses, all your costs when it comes to college, and using as little bit as possible from your retirement portfolio, just like we recommend using as little bit as possible when it comes to loans. Proper planning prevents you being in a situation where you're forced to use retirement assets or retirement savings to pay for college. There are ways where you can find high quality, affordable education, as well as you can find scholarships and other resources to help you come up with a funding strategy that stretches your dollar without tapping into loans and or retirement assets to get the most out of your ability to pay for school. For more information when it comes to finding affordable colleges that might be a great fit for your student, as well as finding scholarships that your student currently qualifies for, please do not hesitate to reach out to us. So as we always say, what you don't know can cost you. If you need more clarification or more understanding of this specific asset or strategy that I just mentioned, please do not hesitate to reach out to us below. You can comment or you can email us directly at info@agradeabovecp.com. You can visit our website at agradeabovecp.com for more information, for more resources. Thanks again. We'll speak to you soon. Have a good one.